Good morning, folks. Thanks so much for joining us today. We're about 5 minutes out from getting started. We'll get going right after 11 a.m. Thanks for being here, and we'll get going shortly. Good morning, everybody out there in webinar land. Thank you for joining us today. It's Tuesday, December 22nd. We are happy to have you here and excited for today's program. Seeing a lot of familiar faces or names rather in the attendee list. I think that it's appropriate to start here in this holiday week to simply say that we're all really thankful and grateful for you being here, and many of you have attended many, if not all, of our past webinars over the last 9 months. We sincerely hope that we've provided some good value and guidance in navigating this difficult year. And it seems appropriate that what is going to be our last webinar of 2020 is one that is going to tackle a 5,500 plus page piece of legislation that adds to and alters our understanding of many different tax implications and stimulus items and all sorts of stuff. A lot of the bones are still in place, but we're going to dig into that today. My name is Kevin Wilson, and I am joined today by Leslie Bruno and Tracy Clark, two familiar names if you've been to these webinars before. And then we're not even going to count last week due to the technical difficulties we experienced on Tuesday. So his debut today, Rick Taylor, is going to be joining us from our tax department to talk about creating new tax agency accounts. Generally speaking, that topic would be the headliner for a December 22nd webinar as we all just plod towards the holidays and year end. But leave it to the U.S. Congress to, we'll say, break the log jam and give us a big research project to analyze and sift through here at year end. And well, we're here for you, and we're here to bring you the best guidance and knowledge as we understand it now. And obviously we'll be updating that as interpretations come out and as we really understand the way the different pieces of the puzzle all interact with each other. Quick housekeeping items before we get into the presentation today. If you do have any questions for us, please drop those in the Q&A and not the chat function. We do record all of our webinars and preserve them on our website. The Q&A function plays nicely with that recording so that you can see those questions if you need to go back and review. The chat function disappears entirely once we stop the show. So Q&A is the way to go on that, and we will answer those as appropriate during the course of the webinar. And if it doesn't slide in nicely, we'll tackle that there at the end. So we're here from 11 a.m. till noon Eastern Standard Time. And should you find that you have a question about the topics that we present today or anything else related to HR, FFCRA, all these different programs, PPP loans, everything, as those questions, bubble up in your head and maybe you're having a sleepless night, just shoot an email to questions@dominionpayroll.com and we'll be happy to get to that just as fast as we can. As always, you can go to dominionpayroll.com and hit that COVID-19 resource button at the top of the page. There you're going to find recordings of our past webinars. You'll find our future scheduling. You'll also find a ton of forms and resources to help guide you through hiring, firing, retaining employees, tax credits, reporting, all sorts of good stuff. All the regulations that surround gainfully employing people. So that's all at dominionpayroll.com for you. All right, well, without further ado, what we're going to do today is I am going to present a quick overview of the Coronavirus Response and Relief Supplemental Appropriations Act. That does not play nicely with a fun acronym like the CARES Act, so I'm just going to call it the stimulus bill for sake of brevity today. We're going to dig into that from sort of a high level, look at what is included in that. We'll take a look at ERTC tax credits, and then my colleague Tracy Clark has done a deep dive on the payroll protection program, the PPP loans. And so we're going to take a look at what this bill did that passed last night, and what that means for you and your business. We'll take a quick look at the extension to FFCRA. And after that, my colleague Rick Taylor is going to come in and talk about new tax, excuse me, creating new tax agency accounts. So a lot to unpack here, and let's dive in. All right, so what we have been talking about off and on since May, when the House of Representatives put forth what was called the HEROES Act. So, varying sizes as through different iterations, but generally speaking, it was around $1.6 trillion COVID stimulus bill. It died in the Senate. There were ups, there were downs, there were ins and outs, intrigue, and all sorts of excitement around when would Congress pass what economists and everyday guy on the street were calling for new stimulus. When was that going to happen? There are a lot of head fakes and a lot of button hooks, and we occasionally thought it was going to happen. And last night it finally did. Last night, as I referenced, Congress passed a 5,593 page pandemic aid bill. The aid specific to coronavirus totaled about $900 billion. This bill was part of an omnibus fiscal package that would fund the federal government through September 30th of 2021. You may recall that last week, Congress passed a couple tiny spending bills to extend the budget by a day or two as they negotiated this out. So this bill is part of a much larger $2.3 trillion fiscal package that is going to fund the entire government. All right, so here are the big headlines. I'm sure that you've been seeing these, and we've all been sort of speculating around this. And in the last 48 hours to the last couple of days, this has come into focus as what would certainly be in the bill. So these are the big headlines, things to walk away with. Individuals that are making under $75,000, $150,000 a year if you're married filing jointly. Individuals will get $600. So a married couple making under 150K, you're going to get a check from the IRS for $1,200. $600 for dependent children. That's 17 and younger. If you have like a college age student, say a 19-year-old that you still claim as a dependent, you are out of luck. They will not, they can't claim $600, and you can't get $600 for them. So it doesn't affect everybody, but it's something to be aware of, and maybe something that you need to tell your employees about if that applies to them. All right, next big headline, the supplemental unemployment benefit. You may recall that was $600 a week. Raised a lot of concerns, particularly amongst Republicans in Congress, saying that it disincentivized people going back to work. That unemployment benefit, which is federally funded and will be in addition to any state benefits. The federal benefit is $300 a week. That's for 11 weeks. So that will expire on March 14th. And then an interesting caveat, an additional $100 a week to mixed earners. These are folks that maybe freelance part of the time. The example that I saw a lot, say somebody works on a movie where they make a sizable amount of their income in a short period of time, and then they take lower wage work, say working at a restaurant for the remainder of the year. Well, state unemployment would only give them unemployment based on their wages from that lower earning job. And so, it disproportionately lowered what they were eligible to receive. And so there's an additional $100 on top of that $300 for folks that fall into that category. And then I'm not going to dive too much into this, but the new bill passed last night does include a bunch of money for the PPP program. And will allow people who have not applied for it to apply for it, people who have already received it to apply for a second round. But my colleague Tracy is going to dig into that for everybody's benefit this morning. All right, so this was the employee retention tax credit. This was one of those, a black sheep of the CARES Act where everybody was focused on PPP money. For a period of time, you couldn't get PPP if you used this, and there was a lot of confusion around this. And this is just one of those legislative items where some employers have been able to take advantage of the ERTC. Just as a review, as it existed 48 hours ago, the ERTC allows eligible employers to claim a payroll tax credit up to $5,000 per eligible employee for wages paid while closed or having reduced operations. The credit equals 50% of up to $10,000 in wages. All right, so some important things. First and foremost, the ERTC has been extended through June 30th of 2021. So that gets us into the middle of the summer. The tax credit rate will jump from 50% to 70%. So that's a sizable jump in what employers will be able to claim as a dollar for dollar tax credit for keeping people on the payroll. This is going to raise the limit on creditable wages from $10,000 per employee per year, which is how the CARES Act had that established. It's going to go up to $10,000 per employee per quarter. So that, makes it up to $40,000 a year, significant jump. Again, it does expire at this point on June 30th. A nice caveat there that it allows new employers that were established in 2019 or 2020 to take advantage of the tax credit. Previously, you needed to demonstrate past wages, and it made it very difficult, if not impossible, for new employers to take advantage of this. So that expansion is a welcome change. And then the eligibility for the credit, you do have to demonstrate that you are either closed or have reduced operations. That year-over-year decline has been reduced from a 50%, so operating at half, to only a 20% decline. So once again, a welcome change in the sort of the threshold or the hoops that you have to jump through in order to take advantage of the ERTC. So that is a big part that, just pay attention to that in terms of this new stimulus bill. So as I said at the outset, this is a positively massive bill, spending $900 billion, let alone the full 2.3 trillion to fund the federal government is no small task. These elements that you see on your screen are specifically part of the coronavirus relief. So 82 billion in education funding, that's split amongst colleges and universities and public schools. There's a separate pot of about a little less than 5 billion going to state governors to help with private and parochial schools. A lot of this is really to help shore up, the fact that schools are closed, that schools have additional, costs in terms of personal protective equipment and HVAC upgrades and things like that. So this is supposed to go to initially help with those costs. Notably, a lot of folks from pre-K up to university level have said that this is not nearly enough to cover their concerns right now, but it's certainly not a small drop in the bucket. So, additionally, we're going to see 69 billion go into vaccine distribution. Now the FDA has approved both the Pfizer and the Moderna vaccines. It's going to be a massive, just a record-shattering logistical effort to get that out to everybody who needs the vaccine. Beyond that, airlines, airports, Amtrak, and public transportation will see a bump. Rental assistance, the eviction moratorium for renters has been extended to January 31st. It's certainly something that the Biden administration will be looking at in their first days of office to make sure that as coronavirus numbers swell, people aren't getting kicked out of their homes and forced into crowded shelters and that sort of thing. It's just anything to avoid exacerbating an already dire situation. 13 billion going to the Department of Agriculture, which runs SNAP, so that's emergency food assistance. And And then, we see there at the bottom, 7 billion going to broadband access. And, um, you know, that starts to get towards, when you have a bill of this magnitude, there's, just a classic game in Washington where you've got a must pass stimulus bill or funding bill, fiscal plan for an entire year. And everybody crawls out of the woodwork and starts tacking on their pet projects and things that are near and dear to their hearts. And so there's a lot that's going to come to light over the next couple of days. I certainly have only read the 5,500 odd pages twice now, and I haven't absorbed it all. But no, there's just some notable things. There's a ban on surprise medical bills included in here. So if you say get into an ambulance, you go to a hospital where your insurance is accepted, but they have a doctor that doesn't accept, and they operate on you, that doctor's going to have to negotiate with the insurance to come up with a compromised bill rather than a surprise huge medical bill. 2 new Smithsonian museums found funding in this bill. So in the next couple of years, we should see a Smithsonian dedicated to women and one dedicated to Latino American culture. Big changes to the free application for federal student aid, the beloved FAFSA. If I remember correctly, that is going from, I think, 108 questions down to 32, greatly simplifying anybody. I've got a 14-year-old at home, and Congress is weighing heavily on my head, but so is college. And so I welcome a simpler application there. The so-called 3 martini lunch break, businesses will now be able to deduct 100% of business meal expenses. Currently, they can only deduct 50%. This is something the Trump administration was big on, and businesses have really pushed for this. And then, as always, you can call it pork unless it's your industry and you're benefiting from it. But there's 80 plus tax breaks included in this. Mitch McConnell's home state of Kentucky got their racehorse tax deduction. NASCAR will benefit from a motorsports deduction. Beer brewers, wine, and liquor distillers, they will all get a permanent tax break, also included in all this. What does that have to do with coronavirus? Not much, but it's in there. All right, 2 things notably missing from the bill: direct assistance to state and local governments, and then COVID-19 liability protections for businesses and nonprofits. The first item, direct assistance to state and local governments, was a big part of Democrats' push. And most economists do say that state and local governments are really going to be suffering. They already are, with sales tax revenue down. Funding for state and local governments is in pretty dire straits. And quite frankly, the things that are going to be on the chopping block are going to be cultural institutions, but also fire and police, infrastructure improvement, local education, libraries, things like that. The federal government is not required to have a balanced budget every year, but states are required to. And with all this revenue missing, there's just frankly no way to balance those books without cutting a lot of things. So I know that the Biden administration has made this a big priority, and they feel comfortable punting on this, knowing that they'll step into office on the 20th of January. And I think that's going to be something to look for in the latter parts of this winter. And then liability protections for businesses and nonprofits. This was a big part of a Republican push. McConnell really wanted to see this. He walked away from it in an effort to just get this thing passed. But this basically would protect businesses from being sued should their employees or customers contract COVID while in their space. There's a lot of OSHA protection already on the books, but a lot of small business organizations do see this as a critical piece of stimulus and protection. And so we will see if there's any movement on that. All right, guys, that is my monologue as I wrap up as concise a summary as I could on a massive bill. And at this point, I'm going to give the microphone over to my good friend Tracy, who's going to be taking a look at PPP and idle loan changes in this legislation. Tracy, how you doing this morning?
I'm good. I feel like I've already run the gauntlet trying to wrap my head around all the changes that are going on. But I think that for the most part, they're good changes. So I think everybody will benefit from what we're going to see now.
Excellent. Well, I'm eager to hear about our old friend, the PPP loan program, and I know that we've seen a lot of success with that with our clients and throughout the small business community. So take it away.
All right. Thanks so much. Okay, so this is a really big one. At the beginning of PPP, a lot of people felt like that they were going to be able to deduct the same expenses that they always did prior. Anything that was a deduction was still continued to be a deduction. And then the IRS came out with their proclamation that, well, if you paid for things that would normally be deducted with PPP funds, you weren't going to be able to use them as a deduction. Well, this act has an appropriation in there spelling it out that all of the expenses that would normally be deductions will continue to be deductions, whether or not you paid for them with PPP funds or not. So that's really good news for everybody. Can you go? Thanks. Okay. And then they came out with the next round of PPP funds. So they said that eligible recipients may receive a second PPP loan. So it could be your first one. It may be your second one. They did put a few more parameters in here. They made an eligible recipient, and they said that's going to be any business concern, nonprofit organization. And they did add 501, I think it's 6C, housing cooperative, veterans organization, tribal business concern, eligible self-employed individual, sole proprietor, independent contractor, or small agricultural cooperative that meets the following three requirements. So the first one was that employees not more than 300 employees. So the old one used to be 500 employees. Now they've lowered that to 300 employees. Has or will use the full amount of their first PPP loan. So if you've already gotten forgiveness or you have already got all the paperwork together showing that you will have used all of your funds toward eligible expenses, and had gross receipts during the first, second, third, or only with respect to an application submitted on or after January 1, 2021, fourth quarter in 2020 that demonstrates not less than a 25% reduction from the gross receipts of the entity during the same quarter in 2019. So they're going to allow you to do a look back of the same quarter that you do your application in. So that's new, that before they just had you say that, okay, I'm being affected by COVID-19 and I need the money. Now they want you to actually show that you've had a 25% reduction in gross receipts. It was 30, and then last night they lowered that to 25. So that's good. Okay, so some people may remember that borrowers were required to certify in good faith that the money that they got from PPP funds was necessary to support the ongoing operations of your business. And that is still in there. And the SBA is not going to come after you, just like before, they said that if you're a loan under $2 million, you can just basically put a check mark in the box or initial a place on the application for forgiveness that says, we needed this money to keep going. That's going to be in there again. So some businesses, though, that like this says that had one or two hard quarters, but they're now making ends meet. It may be hard to come back and say, okay, we actually need this money to keep going. Some businesses, it's really easy, like some restaurants and gyms and things like that. They're still struggling, but other businesses have, redefined their business model, and maybe they're doing okay now, and they don't actually need the money to keep going. So that test will present a very important issue. And it's probably best if you talk to your CPA and or your legal or financial advisors about that, whether or not it's necessary for you to continue with your business. Oh, and this was really nice. So there's going to be another application. We already have three out there. If you remember, there's the 3508S, which is for um, loans under 50,000, and then you have the 3508EZ, which is just a little simplified version of the long version, which is the 3508. They're coming out with one more, and this is for borrowers who received less than 150,000. Now, it will be a one-page application, but all the same rules apply. I'm going to tell you that it's my recommendation that you fill out that long application, and you can go ahead and submit the short application, but you would have all of the numbers already entered in, and you would have all the documentation that you need if you do the long form. And to be quite honest with you, if you're a DP client, you are getting all the information you would need to fill out the long form. And again, I, I hate to say that it's the long form because really it's only 3 pages. And if you have a report from our payroll company or someone else's payroll company, it's already done. All those worksheets, all the calculations, all the for the FTE, for the salary and wage reductions, that's already been completed for you. So really all you'll be doing is filling out the first page, and then you'll be doing the second page, which is where you have to certify all the different things about you needed the money, that you haven't reduced people's wages, those kinds of things. So the long form, the easy, either one of those, it's pretty much the same length as far as what you have to put into it. All right, the covered period. So borrowers are now able to choose a covered period that can be as short as 8 weeks and as long as 24 weeks. And a lot of you are probably going, oh my gosh, wait a minute, I thought I already had that choice. A lot of people did have this choice, but if you got your loan after June 5th, you had to opt for the 24 weeks. So now they're saying that all borrowers can choose a covered period that can be as short as 8 weeks and as long as 24 weeks. It does start on that day of disbursement. I can't tell you. I would say that most people got that it started on the day of disbursement. But in the recent weeks, as people have been trying to get all their stuff together for forgiveness, I have run across 3 or 4 of our clients who thought that they could spend the money at a later date, that they could choose the 8 weeks or the 24 weeks when they would spend the money. And that is just isn't true. You have to start on the date of disbursement of the funds. So starting then, you can go out 8 weeks or you can go up to 24 weeks, and that's your choice. Okay, I put a lot of words here just because if you go back and review this, I want to make sure that you have all the words that belong to this. This is the additional eligible expenses. The first one talks about covered operation expenditures, and that's probably the most important to us because it means that the amount that our clients pay towards payroll would be included and can be paid for with eligible PPP funds. You can see the processing, payment, or tracking of payroll expenses, so that we fall under that. Um, Covered property damage, cost defined as a cost related to property damage and vandalism or looting due to public disturbances that occurred during 2020 that were not covered by insurance or other compensation. So you can also use PPP funds for that. Covered supplier cost defined as an expenditure made by an entity to a supplier of goods for the supply of goods that are essential to the operation of the entity at the time of which expenditure is made. And it goes on to talk about that. And then the last one is covered worker protection expenditure. And this would be like anything that you had to do in your business in order to comply with requirements that were issued by CDC or OSHA or the Department of Health and Human Services, like all that plexiglass that you may have had to put up, masks that you had to get for your employees, cleaning supplies that you have to get for your employees. I think even in restaurants, the outdoor seating, I believe that's covered under that. So there's a lot of things that fall under that covered worker protection expenditure. And that will be covered under the PPP funds now and for the next one. So you can use these eligible expenses for the forgiveness of the funds now. All right. This was really exciting to see. So the idle advance is now non-taxable and no longer reduces your PPP loan forgiveness. That was a big one because if you remember on the applications, there was a place where you could put down or where you had to put down what you got from idle, and then they deducted that from the PPP loan forgiveness amount that you had. Now it's just an addition to that. And there's been more money put into the idle fund. So if you didn't get it the first time, you can get it again the second go round. So yeah, I was really excited to see that they're not penalizing people for taking idle. Oops, sorry, that shouldn't be in there. I think I'm done. Yep, I think that's Leslie. And does
Oh,
she
I'm
need
here. I'm here.
Okay.
Hi. Here I am.
Okay,
Um,
friend. All
um,
right. Good to hear you, friend.
yes, yes. Sorry, it was a hectic morning at my house, but it's quiet now, so I can contribute 2 slides worth of information. So the FFCRA was addressed in the bill. So right now, the original FFCRA is still in place, and that applies through December 31st. And right now, it's still mandatory. So again, right now, between now and the 31st, if you have fewer than 500 employees, your full-time, part-time, and seasonal employees are entitled to either emergency paid sick leave or expanded FMLA if they get sick, have symptoms, are awaiting a test, are caring for someone who is sick, or home with children whose school or place of care is closed due to COVID. And these wages are paid by the government up to $511 a day for emergency paid sick leave and up to $200 a day for expanded FMLA. So all of these things we've been talking about for months, still in place through December 31st, still mandatory. So I just wanted to make sure that that's clear because we're still rolling through winter and a surge in cases. So keep that in mind. However, on the next slide, FFCRA in 2021 is optional. So as of January 1st, you can grant emergency paid sick leave and emergency FMLA or not. However, you're still going to get real-time tax credits up to the same dollar amounts. All the same qualifying conditions exist as far as we can tell. And these are available through March 31st, 2021. So in my opinion, it's still a good thing to offer these leaves because if someone's sick, I mean, the whole point is to keep them away from other people. And if you aren't even paying for their compensation and you can swing it from a business continuity perspective, then go ahead and do it. You know, schools are still closed, daycares are still closed in a lot of areas. So what the government is saying here is, well, now it's up to you, employers of 500 or fewer people, to decide whether or not you want to offer this, which is a little dicey to me because a lot of people thought they were optional in 2020 and they weren't. And so I'm not sure how this is going to play out. But my recommendation would be if you have a request from someone who qualifies, try and accommodate it because you're not paying for those leaves anyway. Now, if you have an employee who already has taken all of their entitled paid leaves in 2020, there's not a refresher of those hours in 2021. If they've only used part of it, so this would probably apply for the most part to people, parents and caregivers who are taking EFMLA, because that's a 12-week long program. They can use that balance in 2021. So hopefully you have tracked that. Certainly you could run a payroll report to see if those wages were tracked separately to see how many hours they have left. And then they would be entitled to that between January 1st and March 31st of 2021. And I believe that answers Vicky Quarter's question in the Q&A. Has the sick leave of 80 hours been extended past 12/31 in this bill? So Vicky, the answer is yes and no. It's been extended, but it's now optional and only available to people who haven't used it yet. Let's see. The next question is for PPP, so we'll answer that in a second. But yeah, Vicky, hopefully that answers your question. And I think that's all on FFCRA that I have. If you need more information on FFCRA or need a bit more of a refresher, just type something in the Q&A or send an email to questions@dominionpayroll.com.
I think that brings us to our year-end debut of Rick Taylor, who is going to be covering creating new tax agency accounts for us. Rick, how you doing this morning?
Very good. How are you doing today?
Doing very well. I'm going to pass the mic to you, and the floor is
Thank
yours,
you.
sir.
All right. Thank you very much. I enjoy being the first one to talk about something non-COVID. It's nice to have that, even if it's at the end of the discussion. What I want to talk about today is something that could impact all businesses. It may just impact some. I just want to go over some things to make sure that the process works great on your end and our end, and we're filing and paying all of the necessary taxes for you where they should be at the right times. Adding new tax agencies to your business. What I want to, there's a couple of things I want to talk about on here. Is like what causes the need for the new accounts and why correct setup is so important. How you need to create the account on your end to make sure everything is on file correctly with that agency. And then finally, the steps to reporting it to us once that has been created so we can file everything and make all the payments correctly. First question would be why would you need to add a new agency? A couple of the areas that would affect that would be if you've added a new employee in a state that you did not have ties to before. So for example, if you're operating in Virginia, North Carolina, South Carolina, and given the new virtual world that we're in, you hire someone who's going to be working from home, but it's out of Maryland now, and you don't have ties to that before, you would need to set up an account with Maryland to make sure that the correct state employee, and potentially employer taxes are being reported to that agency. Is it possible that you added a new office location where you're going to have more new employees? And that would be another situation where you would need to potentially set up new accounts in that state that you were going to, if it's something new that you weren't in prior. And there could be other business reasons that aren't tied to these two. These are the two that jump out to us the most, that happen to the most for us on the payroll side, but there could be other reasons internally that may cause a location change or an addition for something. And that's something that could also trigger the need to set up this new account. The biggest part of this is why the setup is so important. When you set up a new account with us, with one of these reasons, that it's going through our customer service department, when it's added in, it is automatically set up as applied for until you provide us that information. There is potential that when we're making these payments and filings, if the account isn't applied for, that several issues can occur. Payments and returns may not be correctly applied to the agency. Depending on the agency, every state agency is a little different in how they process. They could have situations where you're sending a tax return or a payment with applied for, and it's not correctly posting to the account. You could potentially be getting notices saying you didn't file the return, even though it was sent, or they don't have the payment on file because they haven't been able to apply that to the correct agency. The other side of it is many agencies require electronic payment and filing, which cannot be done without the tax ID. Many agencies are going away from paper completely. There are several. California is one of the biggest ones that we deal with on a regular basis, that they won't take anything. They'll take things on paper, but if they take it on paper, they'll automatically penalize you up to 15% of the amount that's being paid. There are certain agencies like Ohio that just won't even take it. If there's no ID number, if the only options we have is we're sending something via check or on paper, they won't even accept it, so it won't post to your account. All of these situations can result in penalties and interest once the account is set up, and once we've got it added on our end. So ultimately, the end of this is the faster that you register and get that account set up and get that information to us, the better it is for all of us involved. It's better for you, for the status of your business, and it's better for you and us because we're making all the payments timely for you and the filings. Creating the new account. This is one of the biggest questions, and it can be one of the more challenging ones as well. There is a link that is on the Dominion Payroll website. I have the link included in here called the dominionpayroll.com/forms. If you go to that, there'll be a map of the United States on there. And if you click on that individual state, it'll give you the majority of the agencies that you would need to link up to go through the registration steps. The vast majority of agencies now, to be honest, I don't know if there is any that do not offer this, but everyone that I have run across give you the option to pretty much do everything electronically. There are a handful of agencies that have some delays, but most of them will create the account when you do it and provide you the ID once the registration is completed. Once you get that, it's very important for us to get that information over to us, as I'll get to later. The biggest topic that does come up sometimes with us is if you're looking for assistance in determining if the agency is needed or with the registration process. Unfortunately, Dominion Payroll cannot assist with that directly. The employees do not have the training to do that. And it's basically more of something that you would reach out to your CPA or possibly an attorney, because you're basically setting up these accounts based on the type of business you have or the needs you have for your business. That's not something we would be able to assist with. We can point you in the right direction, like with the website that we have, and let you know what needs to be registered for. But if you're looking for assistance in getting those set up, that would be something you need to reach out to your accountant or attorney. Last step in the process is, once you've gone through the process and you've set that account up, is how we want to get that over to us. Ideally, we would like to get, like if they send you an email or you get a screenshot at the end of the setup or any document that they provided, we'd like to get a copy of that so we can verify the information completely. If that's not available, we're fine with an email sent to us with the name of the agency and the ID number. The reason we do prefer the first one, just to make sure that we're seeing the actual exact document that the agency provide, to make sure that we're setting everything up correctly, because sometimes there can be different formats to different agency ID numbers. When you have the information, we're asking you to send it directly to our tax department here. The email address is tax@dominionpayroll.com. Ideally, we'd like to have you add in the subject line to ensure the tax setup is saying new agency in the subject line. The goal for this is we have people that are going to be looking for these to come through on our team. So we make sure when that gets over to us, it's set up as quickly as possible, and we're making all the payments and filings to the agencies accurately. That is everything that I have on that topic. If there's any questions on that, you can put them in the Q&A function. I'd be happy to address them.
Thank you, Rick. That was super helpful, and I know that our audience appreciates all that info. And if anybody does have a question following this, do you want them to reach out to questions@Dominion Payroll, or is there a better email address to get right to you?
You can do the questions at Dominion Payroll, and I'll follow up with those directly.
Okay, that sounds good.
Thank you.
Absolutely. All right.
Kevin, can I butt in?
No, please.
So someone did ask earlier, and I responded through the chat, through the Q&A, but they asked about the report that you need to apply for the PPP loan round 2, and it's the CARES Paycheck Protection Program report. So you'll just go to reporting, client reports, and then if you put in CARES, you'll see CARES Paycheck Protection Program report, and it's done by a date range.
Awesome. Well, it looks like there is a sort of related question in the Q&A. Tracy, how quickly do you think people are going to be able to apply for round 2?
Well, I don't know. I haven't seen the actual application come out, and I don't even know if lenders are prepared since it just passed last night. I do know they want to get it out very quickly. So I really, I'm just not sure. I'm not sure.
Yeah, I would say, this also, Trump has not signed this bill yet. Everything indicates that he will be. There's really unlikely there's going to be any snag on that, but it may be today or tomorrow where that actually gets signed. So I think we all expect it to move fairly quickly, given the fact that this isn't our first rodeo. So, I would expect that infrastructure is in place. SBA should move fairly quickly. I sort of related in all of this, Steve Mnuchin, the Secretary of the Treasury, expects that those direct payments to individuals could begin going out as early as next week. You know, and again, it's one of those things where they've done this before. You know, there's some institutional knowledge that already is there. So hopefully this process and this rollout is, you know, just has fewer bumps and side quests than the initial rollout back in March and April.
Yeah, the only other thing, like, I would say that they've got to come out with a new application, though. They can't just use the old one because they don't have anything in there about that 25% reduction in revenue. So that's got to be included. So I don't know how fast Treasury can like pull that together, but that's what I do know, that's not reflected in the old application.
Yeah. Well, I feel bad for any bureaucrats who are going to be putting in the long hours to make this happen. I will
No,
say,
you don't.
I don't.
It's like, you don't feel that bad, do you?
No, not in the least. Not after the long hours that you and I have put in this whole year. Um, I will say though, if I'm just judging by the number of bounce back and out of office emails that I received just yesterday, I think every working professional is out of the office until sometime in mid-January. So I know that people are going to be working on this, but and obviously we will be getting information out to our client base and to the wider community through these webinars just as soon as these things develop and really come into focus. I'm not seeing any questions right now in the queue. I would just really like to take this opportunity. You know, I opened the hour with a message of gratitude to everybody who's been here for so many of these. I'd also like to say to Tracy, Leslie, Rick today, Angie, Stephanie, it's been just a real privilege to work with you guys this year, and looking forward to continuing it in 2021.
Thank you, Kevin. Likewise.
Thank you.
Yeah.
Thank you very much.
Well, without any other questions, I'm going to go ahead and say that, folks, this has been our last webinar of the year. I believe that at last count, we've done 189 of these since March.
Oh my gosh.
And I was looking at the number of attendees that we've had, and I shared this on an internal call, but for our audience out there, we've had enough attendees to fill the Richmond Coliseum and have about 300 people waiting outside. So it's been a heck of an undertaking this year, and but it's been great, and we hope that it's helped in some small way keep your business afloat and keep your folks employed and keep you on the right side of regulations.
Well, some of these listeners have truly bought the season pass for the Coliseum, if we're going to stick with that analogy. I mean, it's amazing how many of you have tuned in over and over again to hear us blather on about this. And so we're truly appreciative, as Kevin said. Then we never knew we would be here after, when we started back in the spring, and we're going to continue on into 2021 and see what that brings.
And we're going to monetize this in 2021, right? That's the plan.
Right. I hope you've enjoyed the free ride, because soon it'll cost something now. Just kidding.
Well, I think with that, I think that we're going to do our final sign off. Guys, have a great holiday season. Stay safe. Don't forget to wash your hands. It's my admonition always. But it looks like there's a light at the end of the tunnel, both in terms of a vaccine, economic stimulus. Here's to better days. They are ahead.
Yep, for sure. I'm working on vaccine stuff right now for a webinar the week of January 4th, I think it is. So see you guys on the other side.
Sounds good. Take care, everybody.
Bye.